The DRD, dividends received deduction. Now, this essentially exists to prevent triple taxation. Now, you thought double taxation was bad enough. Well, we've got triple taxation, which in theory is eliminated by this. So don't worry. This is a tax provision that allows C corps to exclude a portion of the dividends they receive from other corporations from their taxable income. The purpose here is to reduce the impact of double taxation on corporate income and encourage investment in other corporations. I know it says double, but if we didn't have this, it would result in triple. When a C corp receives a dividend from another corporation, that dividend is generally considered taxable income, as it would be if you received it. Anyone who receives a dividend, it's taxable income. I mean, even if you're a not-for-profit organization, tax-exempt org, you get that. It's considered taxable, but then because of the organization you don't pay taxes on it. But overall, dividends are taxable income. However, the DRD allows the receiving corporation to exclude a portion of that dividend from its taxable income, effectively reducing the amount of double taxation, which is great. It's wonderful to see. We're going to have some items to memorize, some thresholds to memorize. This is super important for the exam, so make sure you know it. Here we've got our dividend received deduction rates. Memorize these. No thoughts about it. Memorize these 100%. Have these down. Surprisingly, also, it does come up on the financial exam. Hopefully, they remove that because it's a little ridiculous that you have to know something like this for financial. But definitely memorize this. So if you own between 0%, not really 0% because then you don't own anything, but 0.000001, something like that percent, there's 20% of a company, whether you're a small corporation, a large corporation, you own between these amounts, you get a 50% dividends received deduction. If you have between 20 and 80%, you get a 65. And then if you own 80% or more, you get a full 100, meaning you don't have to pay taxes on those dividends. Essentially, it's kind of like, hey, you're getting to the point of consolidation. So it's just transferring funds, transferring wealth between parent subsidiary situation like that. So just definitely memorize these. We'll see lots of examples, questions with these. Memorize the thresholds. Just not much more to say about that. Memorize this, please. Do it for me. Do it for yourself. Let's get you through this exam. Now, these rules also apply to consolidations where a parent corporation and its subsidiaries are treated as a single corporation. For tax purposes, yeah, it makes sense. I mean, it's essentially what I was talking about with the 80% or more. Very good. Very nice. Let's see it in action. All right, starting off strong. Corporation A owns 15% of B and reported the following for the year. We got dividends from Corporation B of $10,000, taxable income of $30,000. So from our chart to memorize, as you will, we've got between 0 and 20% ownership. So that means we can deduct 50% right here. So the only amount of actual dividends we are going to see is $5,000. The limitation here, $30,000 of taxable income times 50%. That is $15,000. Now, since $5,000 is less than $15,000, Corporation A can take a DRD of $5,000 against that $10,000. Next up, we've got now 45%. We just see the same thing, how it rolls through. $20,000, $40,000. We're using 65% here. This is the weird one, I'll call it, because 50% is pretty nice and clean. And then you got 100%, again, nice and clean there. 65%, it's kind of the weird one out here. We see 65%, that is going to be $13,000. Now, what's our limitation on the DRD? That's going to be based on our taxable income. It's 26. Well, since 13,000 is less than 26, we could take the full DRD of $13,000 against the $20,000 of dividends that we received. And here we go. Now we're in the upper echelon. We've got 85%, which is between 80 and 100. Perfect. We've got Corporation E and F, 15,000 of dividends from F, taxable income of 25. Here we've got 15,000 times 100. We have a full deduction of 15,000. Now, can we take the full amount? Yes, we can, because it's below the limit. So here we're not paying any taxes on those dividends. Perfect. Now, the limitation here, this is in place to prevent you from essentially being a shell corporation, just raking in dividends to get that deduction, but you don't actually do anything. Like, where does taxable income come from? Comes from activity. So again, this is kind of trying to prevent a shell company situation. All right, limitations. Now here, we see that the DRD cannot be used to create an NOL, so you cannot use this deduction to create a loss. while the DRD can contribute to reducing taxable income, think of it like deductions are as credits. Credits, with individuals or even corporations can go past and get you a refund. But nope, DRDs cannot be used to create a net operating loss, cannot create the NOL in and of itself. If the corporation has other deductions that, combined with the DRD, exceed its taxable income, it could result in an NOL, but the DRD alone would not be the cause of the NOL. Now, if the corporation's taxable income is insufficient to fully utilize the DRD in a given year, the excess deduction typically cannot be carried forward to future years or carried back to previous years. All right, let's run through an example here. First off, we're considering Corporation A, which has the following financial information for the given tax year. We've got gross income of $100,000. We've got other deductions of $90,000, these being just normal deductions you'd see on the face of a 1120. Then we seem to have a 25% ownership in a domestic corporation. Keep in mind, it is domestic. You don't get this benefit if it's a foreign corporation. So this would not be given to you at this point, but we're giving it to you here so you memorize. 25% that falls between our 20 and 80%. So that gives us 65% of a deduction. First, what's our taxable income before applying the DRD? Well, that's just our gross income minus the other deductions. So that gives us $10,000. Next up, we're calculating the DRD, considering the 65% rate, but this is limited to our taxable income. So we see here that $15,000 times 65%. This is our amount we can deduct, but this is limited to $10,000, which is the taxable income before the DRD. However, we don't reach that limit, so we can take the full $9,750 as a deduction. So what happens? We subtract the DRD from the taxable income before the DRD to get the final taxable income. So we have $10,000 of taxable income minus $9,750 of our DRD, which gives us $250 of actual taxable income. Now, in this scenario, the DRD did not create an NOL, and there's no excess DRD to carry forward or back. If the other deductions had been higher, such as 105 instead of 90,000, resulting in a negative taxable income before applying the DRD would not be utilized at all, and it would still not create an NOL. The NOL would result from other deductions exceeding gross income. That's something we've seen here and there, and I love this approach. Change one thing. How does that change the question? Well, there you go. Now you see. Next up, we've got Corporation A yet again. We've got some similar information here, but it looks like, well, kind of what we saw prior. We are going to have deductions in excess of gross income. So we know right away that's going to create a loss. So just a lot of the same information here. We're jumping down here. Our taxable income is negative $10,000. So, that's not good. So since the taxable income before applying the DRD is negative, we're not going to use the DRD. The entire negative taxable income of negative $10,000 becomes an NOL without any application of the DRD, and we deal with the carryback and carry forward for the NOL. Now, in this scenario, the DRD did not help at all because we couldn't use it. This example emphasizes that the DRD can reduce taxable income, but cannot on its own actually cause an NOL. If the corporation's other deductions exceed its gross income, an NOL may result, but any unused DRD in that year typically cannot be carried forward to future years or carried back to previous years, as compared to NOLs, which we can carry forward and back. Here are some more limitations for DRDs. Gosh, so many limitations. You hate to see it. First off, personal service corporations. These are corporations that primarily provide personal services, such as accounting, law, consulting, or engineering to clients. Since the income generated from these services is typically taxed at the individual level, personal service corporations do not qualify for the DRD. Just a point to know. Make sure you memorize that. Personal holding companies and S-Corps doesn't apply there as well. I mean, yeah, S-Corps makes sense. It's a flow-through entity. A personal holding company is a corporation that derives a significant portion of its income from passive investments, such as dividends, interest, and rent. Essentially, a shell corporation, and we're not going to let shell corporations take that DRD. And then S-Corps, they're a type of corporation taxed at the individual level, and oh boy, will we have a great time going through those lessons, with income losses, deductions, and credits flowing through to the shareholders. Because S-Corps do not pay corporate income tax, they're not eligible for the DRD. And well, it'll make sense even more if you're not familiar with S-Corps as we go through those lessons, why that would not be applicable. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.